What's happening, folks? What's today's date, Brett?
Today is October 22nd, 2018. It's a Monday.
We're here this Monday afternoon because we wanted to come at you with some serious market data, right? We're definitely seeing a shift in the market across the board, not just here in the United States, but across the world. With the majority of world cities overpriced, the majority of them, okay? Overpriced and overvalued. So let's talk about why buyers in particular are slowing up, snatching up properties here in town. Let's, if you were to guess, what do you think the number one reason is?
I think probably the number one reason people are kind of hesitant is because prices are a little bit high, per square footage in the inner cities, or anyway, just in cities, metropolitan areas in general. I also think that after years of really low interest rates, we're seeing a pretty significant hike as of late in average interest rates across the board, and that goes for just about every type of loan. Mortgages in particular is what's going to be affecting buyers' decision-making process right now. That's probably my number one guess is home prices. Availability is another one, but basically things are just getting more expensive. It's more expensive to buy a house, and it's more expensive to borrow money.
I agree. Now, this is 2018, the beginning of the year. What do we start off with our rates?
The beginning of this year, rates were in the low fours, high threes, and they've steadily been increasing.
Where are we at now?
Average interest rates right now are about 4.9% across the board.
Whoa, 4.9, creeping up on 5.
Creeping up on 5, and that's average, which means you're getting those some of those interest rates for lower qualified borrowers are up in the mid 5s and even the high 5s and low 6s. In fact.
Wow. Yeah, if you're paying high 5s, in the long run. If you buy a $500,000 house at 5.5% interest over 30 years, they're really paying, how much are they paying for that house?
Well, your all-in costs, if you keep the house for 30 years, you're looking at probably a $800,000 investment. And those are just rough numbers off the top of my head.
$800,000.
Typically, you're looking at 1.5 to 2 times the actual cost of the house over time, with interest.
So it looks like you prepared something for us today, some data.
That's right, Greg. So what I wanted to do is kind of inform the consumer why interest rates are going up. Basically, you may have heard that the Fed has raised interest rates, and I want to describe what that means and how it affects the consumer.
Please do. Yeah.
So the Federal Reserve Board basically controls interest rates when they lend money to banking institutions. Banking institutions are required to have a minimum reserve of liquid assets in their bank. And sometimes with all of the lending that they do, they don't meet that minimum reserve. And so they borrow money from the Fed in order to have that cash available if needed. Now, the Fed controls the interest rate on which this money is returned. And in times of fast inflation or high inflation, the Federal Reserve increases the cost of that borrowed money. Now, since December of 2015, we've had 8 interest rate hikes from the Fed. And what happens is the banks and the lending institutions actually pass the cost of that interest rate hike onto you, the borrower. Now, while the Fed can meet, they meet 8 times a year and they can change the interest rate instantaneously, lending institutions, which are competing in a public market, have to kind of take their time with those increases. And so it takes a little bit more time for the borrower to see the effect of those interest rate hikes. So it's a little bit of a slower, gradual rise, and we have seen that, and it's continuing. Now, the Fed increased the interest rate in September up to 2.25%, and that's on borrowed money from banks on an overnight basis. And so since it's been raised so much since December of 2015, we've seen that interest rate come back on mortgages all the way up from an average of 3.6 in July of 2017, average of 3.41 in July of 2016 to the
3.41.
Right, to that 4.9% we see this month in October.
Yikes.
Now, the Fed is expected to hike interest rates again in December, and according to some of the sources that I have been following, there doesn't seem to be any chance of the Fed slowing that down in the next year or two.
No chance, right?
No chance. And so we're going to see those mortgage interest rates rise over time. Now, I do want to mention that this does sound all doom and gloom, where eventually you're going to be paying a lot for mortgages, and as interest rates rise, it seems like it's going to be very expensive. But I do want to point out that the 30-year average interest rates for a 30-year mortgage, meaning over the past 30 years, the historical average is well above 8%.
Wow.
And so sitting at 5 or 5.5, that's generally still good. And I think that consumers got a little bit used to the benefit of having extremely low rates in the 3s. And historically, we've just never seen that before. So there's no reason for people to kind of freak out, because even at 5%, that's a historically low interest rate. And as rates rise, I think right now is a very good time to still take advantage of that lower rate.
That's incredible. Now, I just heard the other day in the realtor grapevine that mortgage brokers like yourself are offering 0 down loan programs.
Yeah, that's correct, Greg. There are several options for a borrower to get into a house with a minimum down payment, 0 down payment in the case of USDA loans in certain areas. And then there are also government organizations that provide grants to first-time home buyers, to teachers, other service people such as police, fire, EMS, nurses. So there are state programs that we at Home Trust actually participate in, and we can help people get cash assistance in the form of a grant or what we call a silent second. It's basically a 0 interest, 0 payment second loan. Some which are actually forgivable over time, and others which are only paid out when the original mortgage that this is attached to is paid off.
That's incredible. Thanks for sharing that.
Absolutely.
Now, what I want to do, since we're here, I want to kind of break open the credit score myth. You know, people think, oh, I need to have 700 credit score to get a house, right? Well, what's the lowest somebody can have realistically? Actually get a decent rate and all that stuff.
Sure. Well,
Yeah.
for FHA loans, we at Home Trust go down to a 580 FICO score.
Wow.
And since we have access to such a large array of programs, we can do that and kind of mix and match. However, with a low credit score like a 580, you're going to see a premium placed up front.
What's that look like, that premium?
Typically, it can be 1 to 3% of the loan amount. And when you're looking at that dollar amount, in order to get this loan, which is actually still at a fairly higher interest rate, maybe like 6.25%, the amount of money that it costs to get into that loan product, typically on most borrowers, we can put them on a program where they increase their credit score to that 620, and at that point, you're getting a much better interest rate. For instance, Greg, I have a borrower who is in my credit counseling program right now, and their score was a 595. And in order to get into this loan program, the FHA loan program that I mentioned, which has the credit score range 580 to 620, they would have to spend about $5,000 up front as a fee to the investor that we use that loan program with. Now, I ran some credit simulators for this borrower, and it turns out that it would only cost about $2,800 for him to pay off some debts and increase his credit score to about a 630 at that point. So you're looking at about a $2,000 difference, and then over time he's looking at a 5.25% interest rate rather than a 6.25% interest rate. So
and that's where you really save the money there.
Yes, over time, exactly. And I mean, that's kind of like what we like to do when it comes to looking at credit scores. Instead of just taking the first option, I want to look at all the options and give the best option to my borrowers.
Mm-hmm. Mm-hmm. Now, would you recommend somebody invests or pays off their debt first?
I recommend paying off debt first, and there's a number of reasons for that. Primarily the fact that a lot of debts, such as credit card debt or lines of credit, they can change the interest rate on those. If you read the fine print on your credit card agreement, it actually states that they can change your interest rate. And if you're carrying debt, it compounds. It's compound interest, just like investments. Any debt that you have outstanding, that is going to offset any savings that you have. Now, it's a great idea to have savings, to have reserves in cash, but once you have the minimum that you need, paying off those debts is really important for another reason as well, because in qualifying, we use all of your current debt to count against you. So we use what's called debt to income ratio, which we have spoken about in other videos, but perhaps people don't remember. But
for those just chiming in.
Those just chiming in. Chiming in. We're chiming in. For those just joining us on our series of videos. In qualifying for a mortgage, we use a debt to income ratio that's based on your income versus all the monies that you owe on a monthly basis, including your mortgage. So if you have a large outstanding balance on a bunch of credit cards, we use that number included with the mortgage payment. And so the less debt you have, the easier it is to qualify you on a debt to income basis.
Right.
The third thing is...
Oh, please.
When it comes to going back to credit scores, now you've got me on a roll, Greg.
Yeah, let it rip.
But the third thing about carrying debt versus savings is that that credit score is highly affected by how much debt you carry versus your total amount of credit available. So if you have a $10,000 credit card, Greg, and you carry a balance of under $3,000, which is 30%, you're maximizing your allowable or you're minimizing your credit usage, basically, and that is going to provide a high score. Now, if you have a $10,000 credit card and you are utilizing $9,500, that's going to reduce your score significantly.
Oh yes, I can attest to that. I have a very small credit card, and I reached a pretty high amount, close to my limit, and I noticed my credit score dipped 30 points as per Credit Karma, because of that credit card utilization for that one small card.
You know, it's the single biggest factor in determining your credit score, even more than late payments and other delinquencies.
Wow. Oh, now that's a golden nugget if I ever heard one. So anything else you want to share with the viewers here that they should know about today's market? What can we see in our forecast here in the United States?
Yeah, I mean, in my opinion, I definitely see rates continuing to rise. Values are rising as well, and those are the two biggest reasons why you should buy now. And I know that a lot of consumers and potential buyers are concerned about things like their credit score, as well as saving for a down payment. And I think that we touched on some of those reasons. So just to recap, if you think you don't have enough down payment, we have options to meet your needs. If you think that your credit score is not high enough, we can put you on a credit plan where in as little as 1 month, we can raise your score 30 points. And so I think it's very important for borrowers now who may be on the fence, who might be thinking about buying. I said borrowers, but I meant potential buyers.
Buyers, yes.
But for potential buyers that are kind of on the fence, I think it's very important to get them to have an application with a mortgage lender, such as myself, just so that we can review the status of where you're at, and we won't really know until we look at all the different pieces. And a mortgage application is free with Home Trust Mortgage, and there's absolutely no obligation to move forward with anything. In its bare minimum, what I can be for anyone who's interested is essentially just an advisor to get you on the right foot towards home ownership.
Every success starts with a plan, and very, very few times do people become successful on their own. So if you want to buy a house, it's just a phone call away to help you get started with that plan. So whatever city you're in, whatever country you're in, call your local lender and take the first step towards purchasing a house and making your dreams come true. My name is Greg Carlson with Keller Williams.
I'm Brett Hall with Home Trust Mortgage.
If you like this video, make sure to hit that thumbs up and smash that subscribe button, and we'll see you guys next time.